The rising cost of living in the UK has put a spotlight on this month's inflation figures, which hold significant implications for millions of households. With September's headline inflation rate, CPI, announced at 3.8%, it's time to delve into how this will impact various benefits and pensions. But here's where it gets controversial. While most benefits will see an increase in line with inflation, there are some notable exceptions and changes to universal credit that are causing a stir. Let's break down the expected increases for April 2026. State pension. The state pension is set to rise by 4.8%, in line with annual earnings growth. For the full new state pension, this means an increase from £230.25 to £241.30 per week, which equates to around £965.20 per month or £12,547.60 per year. This amount remains just below the income tax personal allowance threshold, keeping it tax-free. The basic state pension will also increase, from £176.45 to £184.92 per week, amounting to approximately £739.68 per year or £9,615.84 annually. Universal credit. The standard rate of universal credit, UC, is expected to rise by a substantial 6.2%, which is above the rate of inflation. This is a welcome change for claimants, but there's a catch: the health-related element of UC has been significantly cut back. For single claimants under 25, the monthly amount will increase from £316.98 to £336.63, plus £19.65. Single claimants over 25 will see a rise from £400.14 to £424.95, plus £24.81. Partners, where both are under 25, will receive an increase from £497.55 to £528.40, plus £30.85, and partners where one or both are over 25 will get an uplift from £628.10 to £667.04, plus £38.94. However, the health-related element of UC for new claimants will be cut from £105 to £50 per month. Existing claimants of this element will have their additional rate frozen at £97 per week until 2029-30. These changes are a result of the government's Universal Credit Act, which increased the standard allowance while reducing the health-related element. Personal Independence Payment, PIP. The payment rate for PIP is expected to increase by 3.8%, in line with inflation. This benefit, which is related to health and disability, is paid at a higher or lower rate for one or two parts. The uprating will mean an increase from £73.90 to £77.45 for the daily living lower weekly rate, and from £110.40 to £115.70 for the higher weekly rate. The mobility rates will also see an increase, from £29.20 to £30.60 for the lower weekly rate, and from £77.05 to £80.75 for the higher weekly rate. Pension credit. The guarantee amount of pension credit is usually operated in line with the state pension's triple lock guarantee, so it's expected to rise by 4.8%. Unlike most other benefits, pension credit is not paid at a set rate but tops up a person's income to a guaranteed minimum amount. From April 2026, this amount should increase from £227.10 to £238 per week. Carers allowance and attendance allowance. Both of these allowances are set to increase in line with inflation. Carers allowance will rise from £83.30 to £86.47 per week, and attendance allowance will increase from £110.40 to £114.60 per week. Housing benefit. Housing benefit is unique in that it is paid by local authorities to households in their area, and the amount varies based on local housing allowance, LHA, rates. These rates are calculated by the DWP based on private rental costs in that area. After a 4-year freeze, the rates were repegged to the cheapest 30% of local rents in April 2024. However, the Labour government has announced that LHA rates will be frozen again, meaning that anyone receiving housing benefit should not expect an increase in April 2026. For more detailed information on benefit and pension payment dates, as well as cost of living support, be sure to check out the Independent's regularly updated guide. And this is the part most people miss. While these increases provide some relief, the rising cost of living means that many households may still struggle to make ends meet. It's a delicate balance, and the impact of these changes will be felt differently across the country. What are your thoughts on the matter? Do you think these increases are enough to keep up with the cost of living? Share your insights and experiences in the comments below.